All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Ryan Kimmel.
Yo, yo.
It's just after 10 a.m. here Pacific time, April 25th. It seems like we got one more week in April. It seems like this month has been incredibly long, even though like the last couple weeks have been pretty calm. I guess the volatility at the beginning of the month really just it just made it feel like it was forever ago. I don't know if it's just headline fatigue or just normal fatigue setting in. Maybe it's just like the little gloominess that we've had here over the past couple weeks that really, I guess, bringing things down a little bit. Hopefully, we can liven things up here. Yeah, not too lively, not as lively as it was at the beginning of the month, let's say. With that, let's get into the where are we for the week. S&P up 4.3% as of time of recording from last Thursday. The big winners were tech, consumer discretionary, and communication services. Your top three. Tech up almost 8%. Consumer discretionary up 6.25%. Communication services up 4.25%. We had one negative sector. Consumer staples down almost 2%. The real estate was the kind of second worst performing sector. It's flat on the week there. So a pretty good week there for the S&P. Month to date, though, still down 1.75%, with the tech the only positive sector on a month to date basis. Pretty surprising there for me. Up about 60 basis points on the month there. Your big loser, energy, down 12%. On the week, you had the Russell 1000 up 420. You had the Russell 2000 up 360. Growth up 6%, and value up only 2%. So kind of the story that was the story of 2024 kind of played out this week. And also, looking at the NASDAQ was up 6%, and S&P equal weight up only 2.75%. Still, though, from the highs of February 19th, S&P still down 10%. So we're still in a correction. NASDAQ down 13.6%. So even with the moves this week, we're still below that down 10% mark from the highs. Shifting over to the bond market, pretty quiet week in the bond market. You had the 10-year down 6 basis points to 427, the long bond down 7 basis points to 473, and the 2-year down 2 basis points to 378. Just given those moves, it's been pretty consistent. Monday was 10-year was up 9 bips, came back down yesterday and today, and then they're at 427. Given those moves, not surprising, the ag was up 60 basis points. Your big winner was investment grade credit, or investment grade corporate bonds up 1%. Agency mortgages up 75 or 3/4 point, and government's up 40 basis points or so. The non-index sectors actually did better, with high yield up 1.25. Bank loans actually were up a little bit less. They're up almost 1%. And the emerging markets up 1.25, the best performer out of all these sectors that we look at here on a weekly basis. Year to date, ag still up 2.6, high yield up 1%, EM up 2%. So pretty good year so far for the bond market. Hopefully that can keep that up. We'll see what happens with rates there. Commodities were flat. We'll call it down 25 basis points for commodities, flat given the volatility in commodity land. Energy, the big loser, down 3%. You have industrial metals up 2%. Precious metals, including gold, was down 40 basis points, with gold down almost 1% there. We're at 32.72 on spot gold right now. It was down over $100 a troy ounce there on one of those days, and it seemed like it was a pretty volatile week there for gold. Still up 24% year to date, 5% on a month, but given a little bit back this week. As I mentioned there, you have WTI crude oil at $63 a barrel, down 1.5% on a week-to-date basis, down 9% year-to-date. And there's talk of OPEC Plus even increasing, maybe not increasing production, but not cutting production, and really being a case where it seems like the oil market continuing, or could continue its decline there, and could get into that 5 handle in terms of WTI price per barrel. I don't know, Ryan, if that was pretty fast there to go through everything, but given it was a pretty quiet week, seems like we can just get through the what the market had told us.
Yeah, I think it was interesting though. Like when we came in on Monday, it looked like we were in for another volatile week. We had those headlines from Trump over the weekend. discussing Powell in not so much of a positive light. And you really saw just this like crisis of confidence in U.S. assets, and with the Fed independence kind of coming into question, and risk assets are under pressure. We saw the dollar move further lower. The dollar index, I think it reached the lowest levels in multiple years, and we really saw some stability come in once Besant had a speech earlier in the week where he was discussing kind of reiterating his view of kind of a strong dollar stance, which I think kind of alleviated some of that market pressure. And he also had Trump say, "Hey, I wasn't thinking about firing Powell." I don't. So he kind of fully retracted that view, and I think that gave the market some peace of mind. And then you also had some Fed speakers out, Waller and Hammock, saying that they'd be ready to act if we saw kind of further weakness in the labor market and tighter financial conditions. So I think that in aggregate kind of redirected the market from kind of the pressure we saw on Monday.
Yeah, it does seem like every time you get a little bit of a walk back on one of Trump's, I don't want to say policies, one of his ideas, then the markets tend to rally from that. No more firing Powell. We were not having auto parts tariffs or kind of I don't want to say loopholes either, but some less tariffs than maybe the people market was thinking. The stock market and risk assets continue to rally. So I guess that's what the market thinks of Trump's policies or his ideas out there. But the fact that we got a pretty good rally this week, that and especially the last 3 days, it seemed like it was pretty strong. I think yesterday you were out on the highs of the week. Today we're even higher today. So we'll interesting to see over the next 3 hours or so whether the stock market can hold and go out on the highs, and people want to be long over the weekend as opposed to people always worried about being long over the weekend, which had been the case for the past couple weeks, I'd say.
Yeah, it's nice. We're seeing the VIX now at 25. That's kind of right where we were, just following the Liberation Day. So it definitely, seems like there's some alleviation in the markets.
And even though markets don't seem to be paying any attention, it's all headline. Markets moving on headlines on what's going on with the Trump administration, not really paying any attention, or not paying much attention, I should say, to the macro side of things. But why don't we kind of give a quick refresh on what happened during the week and kind of see how maybe see kind of how the data points might be affecting what the Trump administration is thinking.
Yeah, sure. I mean, as you said, like the economic data recently has really taken a backseat to the headlines and the news flow. But for this week, it was primarily kind of what I'd consider tier two economic data. Earlier in the week, we had S&P Global PMIs, the preliminary reading for April, and the data was kind of mixed. You saw manufacturing kind of ticked up a bit higher than what was expected, back into expansionary territory at 50.7, while at the same time you saw services decline a little bit more than expected to 51.4, and that brought down the composite index to 51.2, which is still in expansionary territory, but it was a 16-month low. Um, I think the most interesting component from this report was the look we had on input prices. We saw manufacturing input prices kind of increase to the highest levels we saw since the surge in 2022, which is indicative of maybe higher inflation prices that we might see in core goods once we start seeing the tariff impact start to feed through into the official inflation data. On Thursday, we had initial jobless claims. Really nothing to report here. It's been very consistent. Initial claims has been in this like 220K zone for quite some time. And we're really not seeing any sort of indication of weakness in the labor market, at least from the jobless claims data. We're also seeing initial claims for federal employees ticking lower as well. And there's some thinking that maybe federal employees that have been furloughed aren't able, because since they're getting severance, they're not able to tap into the unemployment insurance benefits yet. So keep watching this data for any signs of a setback in the labor market. But as of now, it's kind of steady as she drifts. We also had headline durable goods orders for March. That surged quite a bit, up 9.2% month over month, which is well above the consensus, which is only expecting 2% increase. That was primarily driven by a 139% surge in aircraft orders, which is a very volatile component. If you strip that out, though, the data was kind of, I'd call it softish. What I tend to look at in these durable goods reports is the capital goods orders, non-defense capital goods orders, ex aircraft, and how that relates to the core shipments. And we're still seeing new orders above shipments, which is indicative of stronger investment growth over the coming quarters. So still, I'd say a more positive read on the investment sector as we move into to Q2. And then this morning we had the University of Michigan consumer sentiment. It was the final survey for April. It was revised slightly higher than the preliminary report, which we saw a couple weeks ago, but still very low. The headline number was at 52.2, which it's at areas you only really see during like the depths of crises, like the global financial crisis, like COVID, the depths of COVID. So sentiment, at least from the consumer perspective, is very um it's definitely on the back foot. And when you look through the underlying report, it does seem like the weakness is very broad based across most income groups. And it does seem like the higher prices that we've seen over the last 3 or 4 years is feeding through into just this broad based negative sentiment from the consumer. I'd also highlight the inflation expectations from this report. They're quite anomalous compared to other inflation expectation measures that we see out there. So the 1 year inflation expectations were 6.5%. This was revised down slightly from the previous reading from 6.8. But this is the highest 1 year inflation expectations that we've seen since the early 1980s. And even the long run inflation expectations, they're up at 4.4%. They were unrevised from the earlier estimate. And I mean that's multi-decade highs we're seeing there. But I've said this in the past that we're not seeing this uh, rip higher in inflation expectations and like the market-based measures from break-even inflation rates. They've actually been heading lower recently. So, you've heard Powell in the past say that, we're kind of looking through this University of Michigan data. And I think that that is the right approach.
It's
So
pretty interesting given that, most of the time when we think about short-term inflation expectations, a lot of that's just like, what's the price of gasoline? And, obviously you can take the price of the change in your price of oil and kind of extrapolate that out. And so to have a 6.5 in 1 year inflation expectations when oil is at $63 a barrel, where last year, at this time it was at 80, almost $85 a barrel. Um, the everything other than energy must be much higher in terms of people's inflation expectations. And so I always think that when we're going through the inflation crisis that we just had, it was very much like, okay, everyone kind of extrapolates out what the current trend is, especially with gasoline. And so
yeah.
it's kind of interesting to see that that number is that high, even though price of oil is down 20 bucks.
Yeah, I think it's very this survey data is very impacted by just the recent headlines, and we've all seen it. The headlines talking about how the tariffs are going to feed through into very high core goods prices, but in the end, it's the consumption basket is not just imported core goods. There's, as you said, there's gasoline, there's food, there's shelter costs, and I mean we've discussed in the past, like shelter costs continue to kind of normalize back to pre-pandemic levels.
Yeah. I think that obviously, as you mentioned, the market side hasn't gotten out of whack yet, so it's not anything to worry about. But that the sentiment side of things, and this is kind of the first kind of real data we've had like for April. So after post Liberation Day, everything else is kind of pre-Liberation Day. So you don't know how the hard data is going to react. So that'll be the data we're going to get next month is super important to see kind of how the economy is actually reacting to kind of Liberation Day and how it's reacting post Liberation Day. Um,
100%.
all right. With that, as you mentioned earlier, we got some Fedspeak this week that maybe put a little bit of a floor in terms of how many rate cuts we're going to get. You did have Cleveland Fed President Beth Hammett come out and say May's too soon for a cut. May right now probability is 11% of a 25 basis point cut. So she said it's too soon for a cut. And she said, I think we need to be patient. I think this is time to make sure we're moving in the right direction than moving too quickly in the wrong direction. So certainly they think that, or she thinks that, higher rates, or rates should stay higher to make sure that inflation's coming down. And then what she said kind of gave people a little bit more comfort. On the other side was Waller came out yesterday in an interview and said that he wouldn't be surprised if you start seeing more layoffs, and that certainly if you could see a tick up in the unemployment rate if big tariffs come back on. And then he said, quote, I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market. So I still think that's, one side you're like, okay, we're still focused on inflation, got to get inflation down. And the Waller's out there saying more focus on the labor market. And certainly Powell has said in the past, whichever one is further away from their goal is the one they're going to focus on. So if you do get a significant uptick in inflation, in unemployment, then that would bring that further away from their goal. So you might see some rate cuts from that side of things. But we're still in that place where we have those two forces, both kind of equally close to their goal. So it seems like Fed probably just sitting on their hands and wait and see how all this tariffs affect the economy. If we talk, also looking at it, we're 65% chance of a cut in June. We're still it's kind of surprising to me. We're at 3.4 cuts, or 3.5 right now by the end of the year. It seems like we've been at that 3.5, three through four cuts by the end of the year for a while now. It just that first cut keeps getting pushed back. At some point, and we're not there yet, obviously, that pushback is going to lead to less cuts in this year. Right? Because certainly we're going to run out of meetings, but it's going to be at a place where it really feels like we're going to get to I think as Eric said, was it 2 or 3 weeks ago, was like, you're in a bimodal. We're going to get no cuts, we're getting a recession, and you're getting 6 cuts. And we're still in that kind of, I think we're still in that kind of market thought process behind rate cuts.
Well, given how much has happened in the first 4 months of the year, as a lot can happen in the remaining 8.
That's for sure. With that, Ryan, you want to talk about it seems like it's we're getting to the end of the month. Next Wednesday is the last day of the month. So that's when we get PCE, but you want to go through the highlights of the week ahead and on things to keep an eye on.
Yeah, we get good read on the labor market data. On Tuesday, we get the JOLTS job openings data that'll kind of give an indication of labor demand, at least for the month of March. The data is a bit lagged. We also get ADP. We get a first read on Q1 GDP, which the market is expecting to come in at only a positive 30 basis points Q over Q annualized. So that's a pretty significant downshift from Q4, which were running well into the 2 to 3% range. I will say though, the consumption component of the GDP has still been quite strong. the negative impulses are really coming from net exports, which, could be from importers kind of front running the tariffs in Q1. So we'll have to wait and see for that. We also get March PCE price data, which is the inflation measure that the Fed pays particularly close attention to. It's supposed to be, the market expects it to be a relatively benign report. On a month over month, we're expecting headline PCE to be flat, down from 30 basis points. That would bring the year over year to 2.2. So almost getting to that 2% inflation target, of course, pre-tariff. So haven't seen really any impact from that yet. And then on the core side, market expects another benign reading of just positive 10 basis points, a significant deceleration from the previous month. And that would bring the core PC measure down to positive 2.6. So that would be moving in the right direction if it weren't for the tariffs coming down the pike.
Yeah,
We
I was
also
gonna say
get
2.6 sounds like you're almost there. It almost sounds like 2.
I know. Unfortunately, we have
Yeah.
pretty
The big
significant,
unknown here, I
yeah,
guess.
pretty big unknowns. And it's really difficult to model. Really difficult. It's tough to know what exactly gets realized in the coming months. We get a read on ISM manufacturing on Thursday. Market expects it to dip back into contraction. And then we got, of course, non-farm payrolls on Friday. Market is expecting a pretty muted 125K jobs added for the month. That's a pretty significant decline from the previous month, which we saw a positive 228K. Unemployment rate is expected to remain unchanged at 4.2%. So this will be a big number. Fed's going to be paying very close attention to this and, really seeing if this negative sentiment that we're seeing across, the business sector and consumers is feeding through into the hard data.
Yeah, still unemployment still expected to be flat though, so we'll see how the participation rate affects things and how that shakes out. But that seems like I guess we just talked about how the market seems to be ignoring macro things, but maybe it's just ignoring the, as you call them, second tier numbers, and we'll see whether I would still say that the non-farm payroll report on Friday is a top tier, so market probably pays pretty close attention to that. So with that, I think that kind of wraps it up, and hope everyone has a great weekend there, and I'd like to thank everyone for listening.
Yes, thank you to all the listeners out there today on DL Minutes. Hit us up on X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Don't forget, our YouTube channel is youtube.com/DoubleLine Capital. We have Jeffrey Gunlock and Jim Bianco talk from, I think it was a couple weeks ago, moderated by Jeff Sherman. We also have Bill Campbell on the David Line Report on there. So two videos that I highly recommend there. Again, thanks for tuning in. I hope everyone has a great weekend.
Thanks, everybody. Take care.